So solving for expected returns, and that's something you're definitely going to do with. That's definitely something that you're going to deal with in CAPM, and that's something that you need to be able to master. You're definitely going to have a question about this on your introduction to finance exam or final or even assessment project. So that's exactly what we're going to do in this video. We're going to go through a pretty simple question that deals with expected returns. Let's give it a shot. So as you can see in this question, we're dealing with a very interesting idea in which we're going to derive the current price of a stock based on our CAPM consideration and a good old formula that we used in the past. So if we read this, we see that Far North Airlines is expected to pay a dividend. Okay, so that's pretty important. Maybe we'll use it after in the coming year. And dividends are expected to decline at a rate of 2% per year. So we have our growth rate. So it seems like we definitely need to talk about this whole, dividend concept. So we're going back to equity valuation. So that's pretty interesting. So if you would see this on your exam, you'd be like, okay, we got some little equity valuation going on. Let's just write that down. We may have to deal with that. And then it says that the risk-free rate of return is 6%, and the expected return on a market portfolio is 14%. So that's pretty interesting. We're discussing this concept of RF. We know that this is a dividend payment, all right? And we have our growth rate right here. And then we're also telling you that the ERM, which I like to call the ERM, but it's actually the market portfolio. And then we also say that the stock of Far North Airlines Company has a beta of minus 0.25. And the price of the stock is what we're seeking. So this is what we're seeking. All right. So this is really cool. Now, what you need to be able to kind of understand and think about on an exam really quickly is that you're never going to be asked to solve something in which you're not given the right information in the question. So what I'm trying to say is that in this question, they're discussing this idea of the dividend, the whole equity valuation type of concept. And we see that because they're discussing the dividend price in the coming year. And as well, they're discussing this idea of the growth rate. But then conversely, they're also discussing this concept of the risk-free rate and the market return. Okay, so the market portfolio's return and the idea of beta. So just like that, we know that we could be dealing with two concepts, either A, equity valuation. And I'm going to zoom in just to make this a little bit clearer for you guys. So equity valuation. Or B, CAPM. Especially in this case, the SML line, or just the SML because that's redundant, the SML. And that's because we know that the SML is telling you that K is equal to RF plus beta times the market risk premium. So ERM minus RF. So that's pretty important. And C, if anything, we could be dealing with both. Okay. So the first thing that you want to be able to deal with after you've identified these different concepts that are identified in your question, you want to know that, okay, well, is there something that relates to the dividend price? And is there something that relates to K vis-a-vis equity valuation? And if you guys remember in equity valuation, we dealt with our whole constant growth DDM model, okay? So the constant growth DDM. So we dealt with this idea called the constant growth DDM. So the dividend discount model. And if you remember, this essentially said that the price of any given stock today is equal to the future dividend payment, all right, over K minus G. And just like that, this question becomes very, very, very interesting for us. Because what we're asking here is, hey, well, what is the price of the stock, okay? So we could say perhaps that is P0. And then we're also giving you, if we use a different color, we're telling you, well, what is we're telling you the growth rate. And in this case, we're telling you that it's declining by 2%. So just like that, you definitely know your G. Okay? And then we're telling you that, hey, we're paying a dividend. We're paying a dividend in the coming year, and that's synonymous to D1. So already we see in our constant growth DDM that we're seeking our price 0. Okay, so our price today, and we know our dividend for year 1. We know our G. We're not too sure about what is, in this case, our K. However, what we also have is this other concept. This concept of the SML line, and we could underline it right here. All right? And the SML line actually retrieves your K. The SML line, essentially, its goal is to find your required rate of return, your K. And it just so happens that our constant growth DDM will help us find the price today. And in order to find the price today, we're going to need to look at our K. Well, luckily for us, we're able to compute our K from the SML. So let me say this one more time. Because we want to find the price today, and we know that we could find the price today, especially in relation to the dividend price, we could use our constant growth DDM. And we've realized that we actually have a whole lot of information available to us. We have our dividend in the coming year, which is D1. We have our growth rate, which in this case is actually declining or decreasing as years are passing through by 2%. And what we're missing now is our K. And we could find our K thanks to the SML. And the reason why we're using the SML is because we were given a bunch of information that relates to it. We were given our risk-free rate, we were given our beta, and we were given our ERM. So essentially, we're able to find everything. All we need to do now is compute for K. So let's do that. Let's find our K together. And we're going to use the blue color to do so. So let's write this by using, and I'll zoom in just a little bit, by using the SML. By using SML, we could figure out that K is equal to the risk-free rate, which we said was 6%, so 0.06, plus our beta, which in this case is negative. So we could just do this, if you will, plus minus 0.25 times the market risk, that is the market return, which is 14%, minus the risk-free rate. And that gives us following function, okay? And from that, you can quickly see that our K is equal to 4%, or if you want, 0.04, all right? So now we have our K, and all that is left for us to do is to find our price today by plugging in our K into our constant growth DDM, all right? So just like that, we know that we could plug this in to our constant growth DDM, and we'll be able to find the following. We'll be able to see that P0 is equal to D1, as we said, over K minus G. And in this case, this will give us P0 is equal to $8, as we said in the question, over 4% minus, in this case, minus 2%. All right? And that's going to give us, and that's going to give us something really straightforward. It's going to tell us that P0 is equal to $8. And you could essentially write it as 0.4 plus 0.02, because two negatives actually collide together and create a plus. Okay. And then you get that your price today is equal to 133.33. All right. And then if we erase, in this case, we would say that it's B. And if we look at what the actual answer is, we quickly see that the answer is actually B. And this question was really, really interesting because it relates to this idea of computing K, or expected return or required rate of return, by using the SML. And what we did is we figured out, well, how do we actually identify which line to use under CAPM? Well, in this case, it was fairly obvious because we had to look at beta. They gave us beta of minus 0.25. Therefore, there's no reason that we should be using the CML or the CAL. We have to use the SML. And from there, we were able to plug in our K into our constant growth DDM. And in an exam, they may do that to you. They may require you to think a little bit outside of the box and relate two different chapters or concepts together. And that's exactly what we did. And we were able to do it fairly easily. I would like to believe so. So you should definitely look at this problem, add the different flowcharts or pieces of this question that work for you onto your formula sheet, or your notes or your cheat sheet. This is supposed to give you a better understanding of what you may see on your exam. Now, if you need more help or if you want to look at more videos, notes, or even practice problems, you could definitely look through my YouTube channel, Ismahelps, or you could go on my website called ismahelps.com. And if you want to find stuff related to finance, especially intro to finance, you could go to ismahelps.com/com308 if you are from JMSB, or /intro to finance if you're a student from any other school in the world, really. I hope I'm able to help you out, and I hope this was helpful.